Michael, let's begin with the idea that this is some kind of fear gauge. Can you just sort of rip that myth apart for me, looking at the volatility index and what it actually means? Well,
sure. I mean, the VIX very simply is just a judgment about from the market about what expected volatility will be going forwards. But I do think there's some myths, as you point out, and I don't know if this calm has to be that uncomfortable. You know, so the VIX started in 1990. If you actually look at realized volatility as a proxy for the VIX, you can go back much further. I went back to the late 1920s. And what you found is that in 1963, 1964, 1965, you saw realized vols on the 30-day realized vols in the 3s and the 4s. By comparison, today we're in the sort of 7, 8, maybe high 6s, right? So if there were a VIX back in 1963, 64, you would see VIX prints of 7, maybe 6 there. And so I don't think there's any immutable law of financial physics that says the VIX at 9.5 has to be bought and it can only go higher, right? I think, in fact, we may even make history in the coming weeks where the VIX actually, maybe we will see an 8 closing print.
And Michael, that's the problem, that it was introduced in 1993.
Right.
So that our historical range to really look at is actually quite narrow. It's 24 years, and everyone zooms in on this one period, which is the mid-2000s, and says, this is what happens when it's this low. In a number of years' time, it explodes.
The other work I've done, I've also seen that there's not necessarily any correlation between valuation and VIX movements or follow-on VIX movements. In other words, the VIX can move, you know, up to 20 as easily off a 12 times P as it is off a 18 or 20 times P. So when you go back to this 1963-64 timeframe, which I'm sort of particularly obsessed with right now, there are some similarities. One, you had a sort of a stretched equity cycle. You had PEs up in the high teens and low 20s, like we do today. You also had very low and very stable inflation. And what was very interesting to note is that the thing that sort of ended that low volatility period was really, you know, sort of inflation starting to rise higher and bringing bond yields with that. And I think to the extent that we still have a very sort of what I would call a gradualist central banking environment globally, to the fixed income discussion, I think that's going to be really help keep equity vols and cross-asset vols in check here.
So what about that, Aaron? What does the VIX really tell us? Is it really a fear indicator, a fear of inflation indicator? Is that all it's telling us?
At least for us, we don't really see the VIX as a fear of inflation. I think more fear of fear is how we read the VIX, especially on the fixed income side. For us, the inflation side of this really comes in from how aggressive we think the Fed will be, and the VIX doesn't always reflect that unless there's a view that that will lead to some sort of major risk-off move or a big change in uncertainty in the market.
Well, so given that understanding, what do we make of the fact that the VIX is so low right now? Is it simply because we really believe the Fed is not going to do anything too abruptly?
That's right, and I think the markets have seen the Fed hike twice and not seen any negative effects, so there's this building perception that maybe everything is actually okay. Now, my core view suggests that as we get further into the year, we've got, you know, the Fed talking about tapering. We've got some major changes in the markets that are coming up. We've got a debt ceiling deadline that's going to hit later in fall. There's a lot of potholes and landmines that we could possibly hit that would change that, I think, in a heartbeat.